Hi there. Welcome to the Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you this morning. U.S. inflation jumped to 3.8% in April, which is the highest level in 3 years. This comes amid an ongoing climb in gasoline prices that was driven by the Iran war. Gas prices rose more than 5% last month, with other categories like groceries and airfare also seeing large increases. Excluding food and energy, core CPI increased 2.8% from last year. IT services company CGI is announcing Tim Hurlebus as the new CEO effective immediately. Hurlebus served as the Montreal-based company's president and chief operating officer for 2 years. He oversaw operations in the U.S., the U.K., and Australia. And Pet Value's first quarter revenue met analyst expectations as same-store sales remained flat. The Markham, Ontario-based company also cut its earnings forecast, citing persistent consumer weakness and higher costs in the early part of this year. The specialty retailer company says Q1 performance was impacted by a rise in value-seeking consumers. And we're watching U.S. futures for you this morning. It seems as though the tech rally faltering ever so slightly. You can see the NASDAQ down 0.6%. U.S. inflation data also may be impacting these numbers today, as we saw that come out last hour. We'll continue to track that for you before the bell. And we're also watching the TSX today. Take a look at where it finished yesterday, just above 34,000 points, and we'll continue to watch that for you as well. Investors are getting a sense of the effects of the war in Iran today. With April's U.S. inflation reading, consumer prices rose 3.8% annually in the U.S. That's the highest since May of 2023, raising concerns about the impact of inflation on the U.S. economy. Let's get some perspective now from Sadiq Aditya, Chief Investment Officer at BMO Global Asset Management. It's great to have you join us this morning. Good morning.
Thanks for having me.
I guess we'll start just kind of your takeaway, first of all, of seeing these U.S. inflation numbers coming out today. What do you think?
Yeah, I mean, I think we were expecting to see inflation creep up. For the first part of, call it March and April, you didn't really see much of an impact on inflation. And that really is because there was a lagging impact that would occur, gradually over time. And we're starting to see some of that play out now. The longer we see, the old situation remain unresolved, the more likely we're going to see inflation stay at these levels and maybe even inch higher from here as well. And that's obviously going to have an impact on how, people look at their spending patterns, how the Federal Reserve and other central banks decide what to do when it comes to interest rates as well.
What do you think a rough timeline of that would be, for this war to be prolonged, to see kind of a meaningful impact on inflation and on market sentiment, do you think?
Yeah, I think you need a couple of things. One is, what price is oil going to be sitting at, and the duration that it's going to be sitting at that level. I think the trigger point for me is the $100 a barrel of oil. And if we're out 6 months from now, we're still sitting there, then we have a pretty serious impact on inflation. And that does change a lot of things. I think it changes the consumer sentiment dramatically. Consumer spending starts to adjust. Central banks can't even think about cutting rates at that stage and possibly start moving towards rate hikes. So that changes the scenario quite dramatically. And then you will also see some pressure on the earnings front. Consumers obviously will be impacted, but also supply chains and other things will have an impact on input costs. And therefore, you'll start seeing a bit more warnings from companies about future earnings. And that will really dominate the story, despite even good earnings that you've seen thus far. But again, I don't think that's the base case scenario for us. I think this thing does get resolved. Obviously, it's going to take a little longer than people have been expecting. But again, the earnings are very, very strong. And that is right now the bigger story.
Yeah, let's talk about earnings a little more, because the earnings season kind of nearing the finish line here. What's the overall narrative you're taking away from what you've seen so far in this quarter?
Yeah, very good earnings story. I mean, 84% of beats on the S&P, 70% of within sectors have we seen beats coming through. So it's not just technology. Obviously, energy's had a good earnings story as well. But across the board, it's been really strong. But tech really is being the driver of this. And if you go back to the beginning of the year, when earnings were still good, but the momentum had faded off technology, partly because of the, obviously, CapEx spend. People didn't think you're going to get enough revenue off that, from a valuation concern. And what we're now seeing is the reversal of that. It's less impacted by oil. You're obviously seeing more positivity coming back to the tech sector. And obviously with the pullback we saw in February, March, the valuations looked a lot more attractive as well. And so now we're seeing a momentum back into technology, but also into the U.S. names as well. And that was something that was losing traction to international markets.
Yeah, let's talk about that. First of all, tech stocks, like that rotation you're talking about back into tech stocks. Do you think this is kind of a short-term trend or a longer-term trend?
I'm going to say it's a midterm trend. And the reason I say that is because earnings are very, very strong, and it continues to kind of be the highlight of everything you talk about at the moment. So, stock prices have gone up, but the E has gone up. So actually, from a standpoint of P multiples, not really dramatically changing from that perspective. So I think that's an important part. The second thing is that with the energy situation that's going on, again, tech is probably the most immune to that. And so money flows back into the technology sector. Now, I think if we get to the end of the year and if this U.S.-Iran situation is resolved, oil prices start to come down, I think you will start to see a bit of a rotation back into other segments of the market, just like we saw at the beginning of the year. But that's what I said for the short to midterm here. I think you still see momentum in technology. And then later on, I think you start to see a bit more diversification outside just technology.
And it's kind of the same question, because you mentioned we're seeing a bit of a rotation back into U.S. names throughout the last quarter or so. Same question then, short term, long term. What do you think about this trend?
Yeah, I think this might be a bit more longer term. We've been very bullish, and our biggest bullish bet has been in emerging markets, which has paid off really well for us. But we've always liked the U.S., and even when international markets outside of EM were doing better, we didn't think that would last, predominantly because of the fact that we do expect to see the fundamentals not match up with where we're seeing the stock price in international markets. That's the opposite on the U.S. side, where fundamentals are very strong. And unfortunately, the U.S. stock prices were not moving, in tandem with that this year. We're now seeing that continuing on. So I expect the money flowing back to the U.S. will continue on. The only drag I think would be is the U.S. dollar that would, obviously decline some of the return impact you get from investing in the U.S. But again, I think the results we're seeing out of the U.S. market, particularly the U.S. companies, will more than offset that drag you get from the currency side. So overall, I think from a longer term perspective, midterm and short term, we still like the U.S.
Let's talk about gold for a moment, because we've seen gold sliding lower over the last couple of days. Do you think gold is still a good hedge compared to other kind of more defensive options like cash or bonds?
I do. I think, gold has had a fantastic run, and it's kind of defied odds a little bit because it wasn't just a defensive play all those years. It's had some risk-on attributes as well. I think when we saw the initial part of the U.S.-Iran war situation pick up, gold did well. But when it got escalated, it didn't hold up as well as we would have thought. And I think it's kind of one of those scenarios where gold does well kind of in a smoke environment, but not necessarily in a fire environment. And that's kind of where we were at that point in time. Now that I think the fire part is gone and we're kind of still back in the smoke area, I actually think gold will actually be a very good defensive hedge against any increased volatility we might see in markets or geopolitical risks, to the extent that it doesn't get extreme. In the extreme environment, I think what you'll start to see is cash obviously still do better, but bonds actually doing much better too. We're seeing a lower correlation between bonds and equities now, compared to what we saw in 2022 as an example. And so I do think that gold will hold up as a good defensive hedge, but I think there'll be more than just gold that can do that. And I also believe that playing the option market is a better way of playing a lot of the hedges at this moment in time.
And just lastly, Sadiq, I wanted to ask you about emerging markets. You say you're highly optimistic about them, the largest overweight position you have. Why is that, and which markets in particular do you like?
Yeah, the key areas that we've been overweight: Brazil, South Korea, exposure to Taiwan. But we think even China and India have opportunities to kind of catch up over time. Maybe not necessarily in the short term, but definitely over the long term. It's a broad-based economy. Obviously, lots of people in those areas, middle class growing up. But what I love seeing about this is that we're starting to see momentum come back into the emerging markets. It was almost a faux pas to be in EM the last years, and that was probably because of China than anything else. Now that we've seen tensions between U.S. and China improve, and maybe right now with the U.S.-Iran situation, U.S. is going to have to lean on China to help solve this, which means the U.S. will have to owe China something in regards to that. I think that momentum in emerging markets is going to be much, much better. Valuations are a lot more attractive than what we see. Technology boom is strong in the areas I mentioned earlier in those countries. So I think it can be a really well diversified, upside potential here. And I don't think it's just a 3 or 6 month outlook here. We're talking multi-year, where I think we can see emerging market be the best performing geographic asset class.
Okay, we'll have to leave it there. Sadiq Adatia, Chief Investment Officer at BMO Global Asset Management. Appreciate your time this morning. Thanks for joining us.
Thanks for having me.
Up next, shares of Cineplex have dropped nearly 10% yesterday after the theater chain missed estimates despite reporting a smaller loss and an increase in revenue. When we come back, we will hear from Cineplex CEO Ellis Jacob to get his take on the quarter. Blockbusters like Project Hail Mary and Hoppers drew crowds to movie theaters this year, propelling Cineplex to its best first quarter revenue in 5 years. Yet despite the buzz, the movie theater company's shares slipped today. So for more on how the company is responding, we sat down with Ellis Jacob, CEO of Cineplex.
We are very excited about 2026. The slate of movies look really strong. And based on the first quarter results, we are quite excited to see how things go. And this past weekend, we basically had 3 movies that did over 30 million, and that doesn't happen too often. We had Mortal Kombat, we had The Devil Wears Prada, and we also had, the biopic that was playing very, very, very well for us to make three movies. That was Michael, the biopic that I mentioned. So, and there's a lot of great content for the balance of the year. So we are pretty excited about where the focus is and where the company's headed. The studios at CinemaCon were very focused on increasing the length of the windows, which will help us and, take away the confusion of our guests. So thinking they can watch it at home, when the windows are increased in length, they know that they have a great advantage of seeing it at the movie theater, which is a fantastic social experience.
Well, that's what I was going to ask, right? Like, is Cineplex really just relying on great movie content? Because how would you get people to still come to the movie theater for the enjoyment of being at the movie theater, even if the movie they're seeing isn't that great?
No, we have a great mixture of content, and we also have, we are back to the opera, and it's doing really well in a big way. We do concerts, we distribute movies for Lionsgate in our cinemas. So there are a lot of, choices of things you can do. And we also, in off times, use the cinemas for other than movie theaters. As you know, one of the downtown locations is used as a university during the daytime, which adds value to both our bottom line and also to getting those guests to get used to the cinema experience.
And of course, we saw box office concession spending per customer at record highs for this first quarter. Is this a lasting change in behavior, do you think?
Yes, and it continues to improve because as it gets harder with the economy the way it is, guests basically are staying closer to home, and they are having the movie experience as, one of the things that they want to do with their families. And to me, that's very positive. In most recessions in the past, movie theaters have done extremely well because of that particular reason. And when you think about going out to a movie, it's such a reasonable entertainment cost compared to some of the other things going on these days between concerts and sporting events. We are a great attraction for guests.
International movies are becoming a bigger part of box office results. Is this part of a long-term strategy as well for Cineplex, or just kind of like a recent trend that you're seeing?
No, we've been focused on this for many years, and now it's becoming more important. And we just had a Hindi movie, Dhurandhar, which basically was one of the highest grossing Hindi movies that we played. And what is really important is we did 30% of the North American box office, which puts us right on top there with any of the other exhibitors in North America. So to me, that's we are way ahead of the game, and I think there's a lot more opportunities, especially with the different Asian languages that we can play at our theater, and the diversity of Canada, using our data and our Scene Plus loyalty program, which has over 15 million members, is very, very beneficial to being able to deliver.
How are you also thinking about balancing share buybacks, debt reduction, and investing in new growth opportunities right now?
We have to be focused, and we have done some share buybacks, but as you mentioned, it's a mix between the buybacks, it's a mix between investing in the business and continuing to move the business forward in a strong way.
You also mentioned that this is a good alternative price-wise for people rather than going to sporting events, for example. But where does pricing power really sit today in concessions? Like, are you able to raise prices without materially impacting attendance or basket size at all?
We don't raise it tremendously. It's always basically, minimally higher than the inflation rate. But we also at the box office have a huge opportunity because we are one of the few circuits around North America where our premium offerings do phenomenally well, and our guests enjoy those premium offerings. And in a lot of cases, they come and see the movie in multiple different ways. So they may see it in Ultra AVX, they may see it in VIP, IMAX. So they have a lot of choices. Mm-hmm. And they love that because you can't replicate that at home in any form.
Just lastly, you are retiring at the end of this year. Congratulations, first of all. What's the succession planning looking like right now? Is there a new CEO that is yet to be announced, or what's the situation there?
Well, the board and the committee are working hard to find the right individual to take the position, because I've been in the business, as you know, for 39 years. So it's something that, I built up with, and I'm sure the board is going to find the right candidate to take the position.
What does that right individual look like? Like, what kinds of things are you looking for in the next CEO?
Well, the next CEO should be knowledgeable about the entertainment business, relationships with the studios, very focused on return for our shareholders, and making sure our employees and the culture, because one of the things that we've created is we have a very family-oriented culture at Cineplex, and we need that to continue.
That was Ellis Jacob, CEO of Cineplex. Well, soaring fuel costs are sending shockwaves through Nova Scotia's food bank network, shrinking supplies and leaving some users with little or nothing to take home. CTV's Paul Hollingsworth has more on that.
Doris Pettipaw uses this food bank on a regular basis. Today, the fridge and pantry are bare, which means she's leaving empty-handed. If that's empty, where do you go for food?
I go down here, Madden House down here.
So a different food bank?
Yeah.
Reverend Kyle Wagner's church operates the food bank and community fridge.
400 people we approximate every week.
Wagner says the high cost of fuel has put a lot of people in a financial pinch. Food donations are not coming in like they used to.
People that have come to church, many of us are on a fixed income, right? And so to give like we normally would like to, it's not as easy as it has been in the past.
At the Parker Street Food and Furniture Bank, gas and diesel prices could limit food delivery to people who need it most.
We deliver food once a week, and we have volunteers who do that. And volunteers are having to use their own money for gas right now. Gas prices are going up, so that could see us losing those volunteers because they can't afford to drive anymore.
Wagner says high energy prices affect the cost to operate the church, which could impact the future of the food bank.
Oil is up $500 a month, and so electricity is up about $150. So that's significant when you're trying to run a church throughout the week and also a hall that serves as a food bank and a community center.
Reverend Kyle Wagner is trying to find ways to save money. He'd like to install heat pumps at the church along with other high-efficiency options. But switching to those options costs money at a time when he doesn't have a lot to spend. Paul Hollingsworth, CTV News, Dartmouth, Nova Scotia.
After the break, Canadian travel to the U.S. ticks higher for the first time since December. Is this a real rebound or just an easy comparison? The latest data on that is coming up next. Yesterday on Market Call, we were joined by Ernest Wong. He is the head of research at Baskin Wealth Management, and he was covering North American large caps. These were his top picks: Stryker, MSCI, and Waste Connections. Today on the show, we have Christine Poole. She is president and co-chief investment officer at Davis Rea, and we'll be taking your questions on North American large caps. New data paints a more detailed picture of trips taken by Canadians to the U.S., and we now have a better idea of how business and pleasure travel have changed as a result of Donald Trump's trade war. CTV senior correspondent Mike LeCouture has those numbers for us in this report.
Ottawa's Tulip Festival is a huge draw for tourists. These Montrealers used to take an annual trip to the New England coast, but since Canada-U.S. relations started to wilt, they're traveling domestically instead.
Stay in Canada and spend our money here rather than encourage the American people who have this silly leader that they've got.
And it seems they're not alone. Researchers from the University of Toronto analyzed Canadian cell phone usage in the U.S. over a period of 2 years and found a median decline of 42%, more than the initial estimates of a 25% decrease. But that did include freight travel and Canadians who have to travel to the U.S. for work.
We think they're taking a lot more meetings at home in Canada on Zoom.
Researchers say it's even more apparent in some industries hit by the trade war.
You're seeing much less travel to places like Grand Rapids, Michigan. That's not a loss of tourist travel. That's a loss of trade-related travel related to the auto industry.
The new numbers from Statistics Canada show a slight uptick in cross-border traffic last month. In April, 1.8 million Canadians made return trips to the U.S. That's up 1.4% compared to the same month in 2025. It's the first time there's been an overall increase since December of 2024.
There will be those that will not travel to the U.S. no matter what, but I'm seeing many that had that attitude at the beginning are now softening and actually traveling now and going there also.
Despite that bump, Stats Canada numbers show when you compare April of this year to April 2024, before cross-border tensions reignited, travel is still down by 30%.
Stay with us. The opening bells are next. Here are the opening bells at the NASDAQ. First Responders Children's Foundation is ringing the opening bell. At the New York Stock Exchange, the Walt Disney Company rings the opening bell. And on the TSX, the 22nd Annual Equities Trading Conference is opening the market. It's time now for the first 15. This is BNN Bloomberg trading just getting underway. So we're going to check in on the equity markets to see how things are doing to start the day. The TSX starting the day ever so slightly down by 0.1%. So basically unchanged at this point. We'll see if the TSX can continue to make some gains today. S&P 500 and the NASDAQ also down. It seems as though the tech rally stalling a little bit. Investors also wary of what's happening in the Middle East. If we take a look at some Canadian companies that we're going to be watching closely today, First Majestic Silver is one of them. Shares are falling today as the Q1 revenue for this company trailed the high end of analyst estimates. You can see First Majestic Silver starting the day down more than 2%. Pet Value is another one we're watching closely today. We're going to be talking about this coming up. Q1 revenue is meeting analyst estimates, but the retailer is trimming guidance amid consumer pullback. And you can see Pet Value down more than 11% to start the day. So obviously investors feeling a little hesitant about what's happening with Pet Value. Constellation Software is another company we're watching. They're going to be reporting after the bell today. UBS has identified Constellation Software, though, as a stock with high expected returns. So we'll have to keep an eye on that reporting coming out again after the bell today. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, good morning. It's good to see you.
Good to see you as well. Thanks for having me.
So we're going to start with Zebra Technology today. It's boosting its full-year adjusted EPS forecast. Tell us more about what Zebra's doing just to start the morning, I guess.
You bet. Zebra is the top performing stock on the S&P 500 right now, and it is just off like a rocket so far. This is a company that makes a combination of hardware and software for applications like warehouses, etc. So you have tablets, you have printers that are used to print out, receipts, etc. The stock has been kind of on a long-term downslide. Looks like it's opening a little bit lower than the pre-market was up quite substantially. TD Cowen was out with a note this morning asking whether or not the guidance boost that we've seen from from Zebra was going to be believed by investors, and maybe that's the question that the market is asking right now with the stock down, whereas it had been up so dramatically in the pre-market session. The company not only beat in the first quarter, they raised their full-year guidance to the point that what used to be the high end of guidance is now the low end of guidance, and they also have guidance for the second quarter that is well ahead of expectations. But as I mentioned, TD out with a note this morning asking whether or not the guidance would be believed this time, and perhaps not yet. This stock is down 50% from a 2024 peak, and has really struggled to, I guess, deliver on some of the guidance that it has previously put out. So definitely one to watch today. This stock was up double digits in the pre-market session, so not getting off to quite the hot start so far, but we also do have to contend with a market that just saw a hotter than expected CPI print in the U.S. this morning. So that may also be affecting things so far.
Yeah, no kidding. Maybe for the next company, too, that we're going to be talking about, On Holdings is dropping as analysts call out America's miss here. So tell us more about this company and exactly what's going on.
Yeah, this is Roger Federer's tennis shoe company. I guess he's one of the people involved. What happened? On Holding is dropping pretty substantially so far this morning. Yeah, 3.4% down so far. Their results were otherwise decent, except for in the Americas, where they saw a bit of a slowdown. And the Americas account for about 60% of their revenues. There was a Jefferies note out this morning that said that if they see any kind of declines, if Americas go negative, or if direct-to-consumer sales start to dip, some of those margins that they've seen, which have been very strong, will be in jeopardy. And so, kind of a negative look on the company so far. The miss in the Americas, the expectation is that the company will kind of look to APAC, that's the Asia Pacific region, and elsewhere, and also to kind of highlight their margins, which have been strong. But Americas for sneakers, this is where the company makes most of its business.
Interesting. Okay, we'll leave it there. That is Bloomberg's Jeff Morgan joining us live. Jeff, thanks so much. Coming up, Pet Value cuts its forecast and earnings results from First Majestic Silver. We've got more on this right after the break with Grant White. Stay with us. Anyone with a pet is likely familiar with Pet Value. The company reported first quarter earnings this morning. Profit came in lower than expected, comparable sales flattened, and the company cut its sales forecast because of consumer weakness. Let's get more now from Grant White, portfolio manager and investment advisor at Endeavor Wealth Management. He joins us now. It's great to have you. Thanks so much.
Good to see you, Lindsay. Thanks so much for having me.
So we'll start with Pet Value then. I mean, what do you make of the first quarter results for Pet Value?
Yeah, it's a bit of a disappointing result. I mean, it's somewhat mixed, and I think it is getting mixed up here with the CPI results as well. So I don't take too much into the market action today on this. But yeah, it's a bit obviously disappointing. We wanted to see a little bit more out of Pet Value. Now, in saying that, I think that the volatility we're seeing in the markets is actually a really good thing because we're starting to see fundamentals rise to the top, and I think Pet Value could be the benefactor of that. Actually, it's a pretty solid company, and despite I'd say a slight miss today, I think the company is pretty solid on solid footing going forward. And so, there's a lot to like about this business going forward still.
Is that kind of the story, do you think, for all of these companies before we get to First Majestic Silver, is that they are going to get mixed up with CPI results today? Like, do we need to keep that in mind as we read all of these earnings reports?
Yeah, absolutely. I mean, I think that's a good rule of thumb going forward, just on short-term results, because absolutely when CPI is looking high, and that's really more of a story today than anything else, I would say. So yeah, I would keep that in mind as you're looking forward, looking at companies either today or going forward. Fundamentals are really important right now, and I think you want to look at balance sheets. I really think you want to be careful on what pricing you're seeing, and so when you look at a company like Pet Value, we're seeing reasonable pricing on this company, and the pricing is getting a little bit better today, evidently. So I think you really want to be careful on pricing. I also really like Pet Value because it's resilient business. It's sometimes gets treated like a traditional retail business, but what we see is the resilience of people that keep shopping for their pets, no matter what's going on out there. And so I think that's worth keeping in mind. You're not going to see the same cyclicality in this business as you would a lot of other retailers.
Okay, so let's move on then to First Majestic Silver. First quarter revenue jumps on higher metal prices, but trailed the high end of analyst estimates. You think this is a hold still?
Yeah, I mean, I think this is a hold/speculative buy. I mean, it really depends on what you think silver is going to do. One of the things that I like about First Majestic is that this is a really pure silver play, and that's rare to find. I mean, often you're getting silver, but you're getting a whole bunch of other stuff that's unpredictable for you. So if you're really focusing in on silver, First Majestic is a really good opportunity for that. There's really a couple things that you could like about this. One, demand is higher than ever for silver, whether it's for solar panels or EVs or you name it, from the actual operational use of silver. And the other side of it is we are seeing increased demand for safe haven assets. And so you've got this kind of two-edged sword that's going on with First Majestic. So if you like that story and theme that's going forward, then I think First Majestic is still a really good option for that. So I'm a speculative buy on it, given that, I don't like to play those games personally. I don't like to play that with our investors' money. But if you really like the silver story going forward, I think First Majestic is actually a really good option.
Okay, so Power Corporation of Canada, that's another one we're watching for today. Obviously, this one reporting after the bell. What are your expectations, and what's your kind of? You say this is a buy at the moment, but maybe we'll have to wait to see how the earnings report looks.
I think it's a buy, and if the prices get worse, I think it's even more of a buy. Yeah, let's put it that way. This is why I like this company, because it's so boring. I mean, this is one of those traditionally boring companies. You could hold this forever. We've held this for a really long time, and I mean this in the best way possible to all of my friends at Power Corp and their companies. It's a great business. We're looking at it from this perspective. You've got a 4.5 or 4 to 4.5% dividend yield on it. You've got a share buyback yield around 2%. 1 to 2%. So when you add it all up together, I mean, you're at 6 to 7% on total yield if you combine those two together, just to kind of hold the stock. Never mind any capital appreciation on it. So it's a great business. Balance sheets are really strong, and from a pricing perspective, we're trading below historical pricing still at this point. And again, if that gets better today, I think you want to even buy in more to this thing. So it looks really strong from that perspective. There's still that holdco discount that comes with Power Corp. If you added up all the parts, they're worth more than the holding company is. So I think that's a benefit, but I don't think that's necessarily going away either. And you don't need it to go away. It's a good opportunity one way or the other.
Another one we're watching, Element Fleet Management, delivered a record quarter. You say this one's a buy as well.
Yeah, Element's one of those sleepy companies that you'd never think about, frankly. I mean, and actually, this is starting to get into like the real AI story, the real data management story out there. If you're looking for companies that are taking advantage of better data management, Fleet is one of those companies. I mean, one of the things that they're really doing is helping so what they do is they lease out, for example, like cars to companies that have big fleets of vehicles, cars, trucks, you name it. And on top of that, they build out the infrastructure around it. And in the case of like EVs, for example, they'll be leasing you electrification infrastructure around that. So there's a whole bunch of revenue streams that are an opportunity here. But one of the things I really like about this is they're a really intelligent company too. And they're selling data management back to the companies that they're leasing vehicles to, and helping them to be much better at using them. So for example, like better routes means lower mileage, means better fuel economy, or you name it, or better energy use in the case of EVs. This is saving millions and millions of dollars to these companies that are leasing these fleets from them. So they have a huge differentiating factor there. And it's a company that's, again, using AI to actually add operational dollars back into the business, not just theirs, but the companies they serve. So I really like that moat. And again, from a pricing perspective, it's looking really strong right now.
Interesting. Okay, so I want to go kind of smaller picture, zoom out to bigger picture, just looking at the markets overall. Yeah. Obviously, we've been seeing a lot of volatility over the last couple of months. You say you think this volatility is relatively healthy for investors. Why is that?
Yeah, I think it's great. I mean, I think it's one of those things, like when everything is like going up, you know, I had a mentor that used to tell me that when the wind blows, turkeys fly. And that's what we've seen over the last few years. And I think that like what we're getting to now is like really good fundamentals are going to have to come to the top. So this is good because investors are starting to see, hey, there is a little bit of pain. You got to have a little bit of fear out there. And that's okay, because there's going to be opportunities that come out through this as well. I think we're seeing in the companies, some of the companies we talked about today, whether it's Power Corp or Fleet, I think those are really great businesses, and volatility on them, like today, like what we're seeing, this is a good thing. So you're able to scoop up better opportunities. You just have to be ready to go. And so I think it's a good thing. And I think it's reminding investors of what actually is going to carry value forward into the long term. So overall, I think it's a good thing, and we're optimistic, especially over the next year.
Given that, though, I mean, I love your analogy, when the wind blows, turkeys fly. There are probably some areas that you're looking to avoid because of all this volatility, or in spite of all this volatility. Is that right? So what are you kind of staying away from right now?
Yeah, I think you want to stay away from things that like have that people were just buying for momentum. I mean, I think momentum's a dangerous trade right now. It certainly has carried for the last couple of years, but momentum can be very dangerous. And again, I think like if you look at, for example, things that have carried the market forward, the AI in particular, I think you really want to be careful on what you're actually buying today, what pricing you're paying for that. You look at a company like Fleet. Here's a company that's actually using AI to the benefit of, again, their customers and their own business. Canadian Tire is another one that I really like in the space. These are not the sexy names in AI. They're the ones that are actually being functional with AI. And so I think if you focus on those stories a little bit more, that's great. And avoid the ones that are really highly priced because everybody expects them to do extremely well. And those companies are priced for perfection, whether it's, Alphabet or Amazon or you name it. Still great businesses, obviously, but they're priced for perfection at this point.
On the flip side, just before we wrap up, any must-owns right now?
Oh, must-owns. Again, I go back to some of the ones we talked about today. I mean, I think Power Corp is like one of those companies you could own forever. But the must-owns for me is, again, focusing in on fundamentals, focusing on good balance sheets, good free cash flow, and focusing in on pricing. And if you do that across your portfolio today, I think you're going to have a really great couple of years coming up here. If you avoid that, I think you might have a really difficult couple of years. And then not to say that you won't go higher, but I think you're going to miss out on really good opportunities that are there. So I think this is the market where you really want to be ready to take advantage when pricing goes in your favor.
Okay, we'll leave it there. Grant White, portfolio manager and investment advisor at Endeavour Wealth Management. Great to have you. Thanks so much.
Thank you so much.
Still ahead, Canada's wine industry is seeing some strong sales, but a new report shows there's plenty of untapped potential. More on that after the break. A new report suggests Canada's wine industry still has untapped potential. Despite strong sales, barriers remain, and the U.S. market isn't an equal playing field. CTV's Annie Bergeron-Oliver joins us now with the details. Annie, good morning. So give us the highlights of this new report.
Hi, Lindsay. Well, this new report was prepared by Deloitte by Canada's wine industry. And essentially the big headline here is they're saying there's a lot of untapped potential in terms of the wine industry's contribution to GDP. And for that, they blame interprovincial trade barriers, taxation regimes, for example. If you look at overall, what this report says is that Canada's wine industry contributes about $10 billion annually to the GDP. And that's with Canadian wines only representing about 28% of domestic sales. What the report is calling for is for that number to increase to 51% within the next 15 years. And if that happens and these changes are made by the federal governments, provincial governments, this report says that the wine industry could go from contributing $10 billion annually to GDP all the way increasing to $13.7 billion. So quite a significant increase here. And they say really they just need to change the environment to make it easier to sell Canadian wines to get more people into the wine industry. One statistic that I thought was interesting was in Quebec, 166 million liters of wine were sold in 2023, and just 2 million of those were made in Canada wines. So a big difference here. And basically this report is saying, look, make it easier to sell Canadian wines, to get Canadian wines on the shelves. You'll see a big boost to GDP. You'll see a boost to job and economic activity in a range of sectors from farming to agriculture and even tourism, Lindsay.
Let's talk about that further, because there was obviously a lot of talk last year about reducing those interprovincial trade barriers. I believe it's coming up on like a year ago that we were having these talks. What are some of the key issues, though, that we're still facing in terms of reducing those barriers in interprovincial trade?
You're right that we even were having these talks, and in fact, 11 jurisdictions have signed on to an action plan to make it easier to get wine to consumers. But a lot of those haven't really moved. They said they were going to work on making it easier to have e-commerce platforms and retail platforms for people to buy their favorite wines. There hasn't really been any movement on that, and it was supposed to be happening by May 2026. So there has been an agreement to make it easier, but so far it doesn't seem like there's much action on this action plan the government put in place. What the report is essentially saying is that there's too many different compliance requirements, a patchwork of regulations in every province, which makes it really hard to sell wines. In Ontario, for example, there's a 75% markup on wine in the LCBO. That markup is different in Alberta than it is in Manitoba, but each of them have the markup, which again makes it hard for winemakers. They also say they want to see more direct-to-consumer platforms. You're allowed to do that in British Columbia, for example. You can order your favorite wine from Ontario, from Nova Scotia, and import as much as you want into the province. But you're not allowed to do that in Ontario. You can't do that in Quebec. And they're saying, well, why not? Why shouldn't Canadians be able to order their favorite Canadian wine from Nova Scotia, if that's where they used to live or they like Nova Scotia wine? Allow them to bring it in and allow them to bring in as much as they want to have at their dinner table for their friends and family every day. This is one of them. They're also saying the taxation regime needs to change. One of the startling statistics in here is that a mid-sized Canadian winery is paying $372,000 annually in federal excise taxes. A similar sized winery in the United States, they're only paying about $27,000 in tax. So obviously that's a big barrier in taxes in order to get people into the business, to stay afloat. Your profit margins have to be much higher. And they say it also impacts the cost of the wine on the shelves when Canadians go to buy it. So they're saying a lot of changes need to be done here to make it easier to sell and make Canadian wines. And then you'll see a big boost to economic activity, Lindsay.
Wow. Okay, that's CTV News. Annie Bergeron-Oliver reporting live for us. Annie, thanks so much for that. Very interesting.
Thank you.
Coming up, veteran market strategist Ed Yardeni says he has not seen earnings this good in a long time, and it's causing him to increase his target on the S&P 500. More on that after the break. Ed Yardeni is raising his S&P 500 target, pointing to what he calls unprecedented earnings expectations. The Yardeni research president now sees the index ending the year at 8,250, citing strong first quarter results and a resilient consumer. We got perspective from him in a Bloomberg interview this morning. Take a listen.
I don't really recall anything like this. It's been extraordinary. The first quarter earnings expectations really weren't all that bad coming into the first quarter earnings season. Actually, they were holding up pretty well, and instead they turned out to be much better. And on top of that, the analysts are raising their second, third, and fourth quarter numbers. So now it looks as though we're going to have something like an 18% year-over-year increase in the first quarter. And for the year as a whole, they're expecting 24%. And that's definitely unprecedented. That's the kind of double-digit gains you see coming out of a recession. You don't see it in an economy that's been growing for a while.
Ed, looking across industry groups, the semis right now make up about 18% of the S&P 500. How much heavy lifting are the chip players doing?
Well, I think that's part of the story, but we're also seeing that the earnings expectations for the small caps and the mid caps have been going up to record highs. Those two areas of the market were actually sort of in a coma, flatlining since 2022 in terms of earnings expectations. And then over the past 6 months or so, we've suddenly seen them picking up and going to new record highs. So I think earnings breadth is actually improving. And if that's the case, that should lead to an improvement in the breadth of the market.
How sustainable is this, Ed, given the fact that we're hearing about consumers increasingly pushing back on price increases, increasingly being choosy as a result of some of the inflation that they're seeing across the market?
Well, you mentioned it before. There's a widespread belief that this is the K economy, where a lot of people are facing an affordability crisis and only a few people are doing well. I think that's, I'm not dismissing that, but I think a lot of that misses the impact of demography. I'm a baby boomer. I'm still working for a living, but I'm seeing a lot of my friends retiring, and the baby boomers collectively have a record $89 trillion of net worth, and they're starting to spend it. So all this anxiety about disposable income going flat, well, that's natural. I mean, baby boomers are at the peak of their careers and they're retiring, so that's going flat. Meanwhile, they're spending their retirement assets, and so they're continuing to spend. And I think a lot of baby boomers are helping their young adult children, maybe with mortgage payments, helping out with the grandchildren's after-school activities, some of the fees there. I see this from personal experience as well as from my friends. And so I think that's what's missing here, and that explains why the consumer has been so remarkably resilient, and I think that continues. So I don't really buy the idea that this economy is just being propped up by the capital spending on technology by a few companies. I think the consumers are definitely there. And the weakness of the consumer in the fourth quarter and the first quarter was weather-related. So we're about to test that. We'll see what retail sales looks like up ahead here and put it all together. And I think the economy remains resilient as it has been since the beginning of I call it the roaring 2020s, and so far so good.
If that's
Coming up, U.S. stocks are trading lower today as inflation driven by the conflict in Iran weighs on markets. We'll get more on that after the break. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. inflation jumped to 3.8% in April. That's the highest level in 3 years. Now, this comes amid an ongoing climb in gas prices driven by the war in Iran. They rose more than 5% last month, with other categories like groceries and airfare also seeing large increases. Excluding food and energy, core CPI increased 2.8% from last year. Dunkin' and Foodtastic have signed a master franchising agreement with Inspire Brands to open hundreds of Dunkin' locations across Canada. Under the new agreement, Foodtastic will manage market development, franchise recruitment, and operations. The first location is expected to open in late 2026 or early 2027. And shares of Under Armour are plunging today after the sports retailer's full-year sales and profit outlook trailed estimates. In addition to that, the American company has been navigating the impact of tariffs. Today, Under Armour said the conflict in the Middle East would add $35 million U.S. in costs this year. And we're, of course, watching the markets this morning. The TSX starting the day down ever so slightly by 0.3%. We'll see if it can continue those gains that the TSX has been seeing over the last couple of sessions. If we take a look at U.S. markets, it was mixed trading earlier today. Now it seems as though all markets are down to start the morning. The Nasdaq in particular down almost a full percentage point at the moment. The Dow Jones down by 0.7%. Investors very much weighing what's happening in the Middle East. Maybe a prolonged conflict here rather than an end to the war coming sooner rather than later, and we're seeing that reflected in the markets today. U.S. markets are down, as you just saw, from near record highs today after inflation rose more than expected in April. And our next guest says investors are underestimating the risk from the conflict in Iran and how this energy shock will impact the global economy. So joining us now is Phil Orlando, Chief Market Strategist at Federated Hermes, and he joins us in studio. It's great to have you.
Thanks for having me back.
Let's start with that point about the market underestimating this risk. Why do you think that?
Well, let's look at how the market's done. From the bottom of the market on March 30th, over the next 6 weeks, we're at all-time record highs yesterday. The S&P 500 rallied about 18%. The NASDAQ composite rallied 29%. Now, we can understand that corporate earnings have been phenomenal. Revenues up about 11, 12% year over year. Earnings are up about 29 or 30% year over year. So those numbers are very strong. But at the same time, let's take a look at what's going on with Iran. The administration told us this was going to be a limited 4 to 6 week activity. We're now up to about week 10 or week 11. Crude oil prices are up 85%. Gasoline prices are up 50%. And we've saw in the month of March and then this morning with the month of April, that's starting to bleed into higher than expected levels of inflation. I don't think the market has priced that in, because that then has an implication on what the Federal Reserve might or might not do in terms of managing that dual mandate that they have. So the market's very euphoric based upon good earnings, but I think the Iran situation and the inflation situation is something they're not really focusing on as much.
So much to focus on, though, geopolitically, right? Like, we've got U.S. President Donald Trump meeting with Xi Jinping later this week in China. That's a big meeting. There was talk, I heard, that Donald Trump was maybe hoping that this conflict in Iran could be resolved before this meeting. It doesn't look like it's going to be. How do you expect things to unfold when the two sides meet?
Well, I think the administration may be going to China hoping that China could use some of its leverage with Iran. Iran, China, part of the axis of evil. And we know that 60% of the energy that comes out of the Persian Gulf goes to Asia. China's a big purchaser of that. So they've got to be struggling to some degree in terms of they getting the energy they need to run their economy, second largest economy in the world. So I think part of that discussion between Trump and Xi is going to be, can you use some influence here to get the Iranians to open up the Strait of Hormuz? That way you guys can get the energy you need to run your economy.
It's probably going to be the main topic on the agenda, I would think, at this point.
Well, certainly one of the subliminal topics. I think originally there was going to be talk about trade and tariffs.
Right.
Are you going to buy the pork and the soybeans that you promised from us? We want access to some of your rare earth minerals. Let's talk about technology and AI. But certainly Taiwan and Iran are two topics that I'm sure the two presidents are going to be discussing.
For sure. Okay, so let's talk about the U.S. CPI data that came out this morning, rose 3.8% in April. And this is largely driven by the conflict in the Middle East. How do you think this, you mentioned it, but how do you think this will impact the Fed's next rate decision going forward?
Well, I think it's pretty significant that you're also going through a leadership transition at the Federal Reserve. Yeah. All right. So perhaps today, Kevin Warsh gets approved by the full Senate, probably a party line vote. Jay Powell's term expires on Friday. So we're expecting that Warsh is going to be the new chairman. Now, as the Federal Reserve is looking at their dual mandate, you've got the labor market and you've got inflation. The labor market's actually been pretty strong 3 of the last 4 months. We just got the April data on Friday. Inflation is now going in the wrong direction. So if anything, the Federal Reserve is saying, okay, we don't need to cut interest rates because the labor market is doing well. We might have to, at worst, do nothing in terms of adjusting policy, but perhaps raise interest rates in order to deal with the inflation problem. So look at the spread between the upper band of the Fed funds rate sitting at 3.75% and 2-year Treasury sitting just under 4%. What that's telling us is that the Federal Reserve's next move, all things being equal, would be to increase interest rates by a 1/4 point. But that's not Warsh's mindset coming in. He would like to take interest rates down over the course of the next 2 years to what we think is about the 3% level. That's why the Jackson Hole speech that he's going to give at the end of August is going to be so critical in terms of sort of laying out his vision. So as a result, the market historically always tests a new Federal Reserve chairman about a quarter of 3 months or so into his term. If Warsh takes office on May 15th, that would put you into the middle of August, about the time that Jackson Hole is going to be happening. So I think the market could have some volatility coming based upon what may or may not be developing at the Federal Reserve, inflation, monetary policy.
Interesting. Okay, we'll watch for that. Speaking of the markets, there's been a bit of a rally recently, mostly driven by earnings. A lot of really strong earnings reports coming out, especially from the big tech companies. Do you expect the markets to maybe maintain some of that momentum even after earnings season is wrapped up?
So longer term, the answer is absolutely yes. You look at the second quarter, and we're midway through the second quarter. We've just seen bad inflation readings for the month of March, the month of April. May, we're sort of moving in that direction. Gasoline prices are up, 50%. Does that potentially have a deleterious impact on second quarter earnings? Too early to make that judgment, but as we get into June, the back half of June, companies are going to start to provide some guidance in terms of adjusting what sell-side estimates are. So it's entirely possible that if the Iran situation continues to be unresolved, energy prices stay elevated, then companies might pull their horns a little bit for second quarter earnings.
Would you put more money into tech stocks right now?
No. At this point, tech stocks, the NASDAQ composite's up 29% in the last 6 weeks. The S&P 500's up 18%. What we're doing, putting new money to work in the areas that are more attractive from a valuation perspective. So domestic large cap value, international with an emerging markets focus, and the small cap stocks, both growth and value. The technology names and the consumer discretionary names are names that we'd be a little cautious on here given developments in the market.
Any particular emerging markets that you like at the moment?
The index as a whole works. Commodity prices have been strong. The U.S. dollar continues to be weak. Mm-hmm. That suggests that international should continue to do well. Valuation is very compelling. International was the best performing asset class last year. We think it'll continue to be the best performing asset class this year.
Okay, we'll leave it there. I appreciate your time. Thank you for coming in studio.
My pleasure. Thank you.
That was Phil Orlando, Chief Market Strategist at Federated Hermes. Coming up, south of the border, the consumer price index rose 3.8% in April, as we've been telling you, marking the fastest pace since 2023. So we'll have more on that after the break. Stay with us. U.S. inflation was up 3.8% in April as energy prices remain high as a result of the conflict in Iran, and grocery prices are rising as well. This increase marks the fastest pace of inflation since 2023. So we'll get more now from David Doyle, head of economics at Macquarie Group. It's great to have you join us. Thanks so much.
Thanks for having me.
So it shows that the U.S. inflation numbers we're seeing today being primarily driven by higher energy prices as a result of that conflict. Can you give us a little more insight into just how much these higher energy prices have affected inflation?
Yeah, so this has been, I would say, one of, if not the largest gasoline price spikes that we've seen in history in terms of the sharpness of the rise. So over the past 2 months on a not seasonally adjusted basis, you have a record gain. And that data goes back to 1935. So that provides some context in terms of the impulse that's being driven here. In terms of the monthly data for April, the gasoline price was up 5.4% month on month seasonally adjusted. And so that contributed about a third, so 0.2 percentage points of the headline monthly gain of 0.6. So a big driver that you're seeing from energy for sure. And what we're waiting for more evidence of, there's some signs of it already, but we're seeing more evidence of that, is that increase in energy and oil bleeding into the core numbers. So we'll be looking for that in the months ahead.
Very interesting. Besides energy, what other categories saw the most inflation last month?
So look, I think one of the undertold stories of 2026 is tech-related inflation. Now, this doesn't have a huge weight in the CPI or even the core CPI, but things like computer software, computer prices, chip prices have been skyrocketing over the past 6 months. Computer software and accessories up, I think, 5% month on month, 14% year on year. And this is coming after, I think, effectively several decades of disinflation or deflation in tech. So we're starting to see that come through. Now that, again, we should have more of an impact on the core PCE price index that we'll get at the end of the month. But you're seeing that come through. Elsewhere, you did have a tick up or a move up in shelter-related inflation. Owner's equivalent rent, actual rents also rose. But that was more due to measurement issues related to the government shutdown that occurred in October 25. So I think that you can describe that as a one-off. We're more concerned about what's going on in tech. There's no evidence of that slowing, particularly with the CapEx plans that we're seeing from a lot of companies related to AI.
Many experts are kind of warning that fertilizer prices will be a big driver when it comes to food inflation in the coming months. Did you see that in the numbers that we saw throughout the month of April, or is that something you're watching for in the months ahead?
That's something we're waiting for in the months ahead. So yes, you're right. There's a lot more supply constrictions out of the Middle East conflict than just oil and energy. Fertilizers will be one, so we should keep an eye out for food inflation going forward. There's other, commodities, even helium, for example, which you need for semiconductor production. There's a lot of that comes out of the Middle East. So that could exacerbate the tech inflation that I just mentioned. So the inflation story is one of concern right now. I would say that the risks are tilted to the upside relative to where we are now. And of course, all eyes are on the conflict in the Middle East and where that goes.
Is there any positive news that came out of the data today? Like any signs of some numbers at least going down or something becoming a little more affordable that you picked up from the data, or not really?
Yeah, I mean, if you wanted to point to something that's positive, and this is something that at Macquarie we've been commenting on in our reports, is that the tariff-related inflation out of the U.S. looks largely to be in the rearview mirror. There were some studies from the Fed released in the last month that suggest sort of at a detailed category level that we'd had all the inflation that we were going to get from the tariffs that had been put in place so far. And so one of the indicators that we look at for that is core goods or core goods ex used cars and trucks. And both of those were flat month on month in April, which suggests to us that, you probably are in the later innings, if not largely complete from the tariff related inflation. Now, of course, the new concern is that, oil, energy are big inputs into core goods. And so potentially there's another leg coming down the road there. But at least we can be assured that being flat suggests that tariff-related inflation story the Fed was out talking about a month ago, that is supported by this month's data release.
Okay, so a little bit of good news, but obviously inflation ticking higher. How do you think this latest inflation report will influence the Fed's next rate decision?
So look, I think you already saw in the most recent meeting that there was a lot of folks on the fence in terms of whether or not to keep the guidance towards that the next move, could potentially be a cut in the statement. So you had 3 dissents related to that. Chair Powell in his press conference suggested there was a healthy debate about that. So I would guess that when we get to the June meeting, and of course, we are very likely to have a new Fed chair very soon on that front. So that could alter things. But I suspect that it'll be very likely at the next meeting in June that you'll see that guidance withdrawn, and the Fed will move very clearly to a more neutral posture. Now, markets are already pricing that. Here at Macquarie, we felt for some time that the risks were tilted more towards a rate hike. Our baseline remains that you'll get a couple of hikes in early 2027. But we'll see if the data continue going as they have been over the past couple of months, both in terms of the labor data and the inflation data, that could come even sooner, right? It's possible that we see a hike later this year.
Yeah, that's what I was going to say. Like, it's hard to sift through all this different data because you've got higher inflation numbers that we see coming out today. Last week, we saw that jobs data, which showed, a relatively strong labor force in the U.S. Like, how do you weigh all of that, really?
But look, I think that's all pointing in the same direction, right? At the start of the year, we were talking about more cuts from the Fed because there was fears that the labor market was deteriorating. But I think, look, there are some mixed signals when it comes to some of the labor data. But I think in aggregate, when you look at initial jobless claims, when you look at continuing jobless claims, when you look at the non-farm payrolls gains, all of those things are suggesting the labor market is picking up. So we suspect over the next sort of 6 to 9 months, you should see the unemployment rate tick down further. It's only at 4.3% now. We think it could be, closing in on 4% by the end of the year. Mm-hmm. You add that, and then you add the inflation picture, where we're still elevated, potentially moving higher, particularly with these tech-driven categories accelerating. It's going to argue in favor of a hike. Now, whether that comes later this year or early 2027, we'll see. But that's where we think the next move will be for the Fed.
Just quickly moving forward, you mentioned some of the categories of the CPI that you're going to be watching for most closely. It sounds like tech, energy, potentially shelter, food inflation. Is there one that kind of trumps the rest in terms of what you're watching for?
So look, for me at least, I just think it's an undertold or underemphasized story is the degree to which we're seeing tech inflation, right? And tech bleeds into everything. Cars, electronics, appliances. Mm-hmm. Think about the number of things that have semiconductors in them, and those prices they're skyrocketing. And this is after a period where we had several decades of very low or even deflation in tech.
Mm-hmm.
So this is a big shift and a big change. So I'm looking at that as being, the big driver and the one to watch.
Okay, definitely watching that one. David Doyle, head of economics at Macquarie Group. Really appreciate your time. Thanks for joining us.
Thanks for having me.
Coming up, rising inflation, high interest rates, and market volatility. What's the right investment strategy amongst all of this? We'll find out right after the break. Welcome back. It's time now for the ETF report. Oil prices have dropped from their peak, but remain above $80 a barrel and hurting rate cut chances and causing volatility in the markets. So what should your investment strategy be in these conditions? We'll find out now with Prana Matthews, VP of ETF Product Strategy at Mackenzie Investments. And she joins us in studio. Thanks for coming in.
Thank you for having me. Lots to talk about.
So much to talk about. I mean, given all the volatility we're seeing, what's your biggest concern right now in the market?
Yeah, it is investors staying the course. This happens whenever we see a lot of volatility in the market, is how do you stay invested? How do you be patient through those turbulent sort of moments that are going to be temporary, no doubt, but there's a lot that's there that we're dealing with. We've got inflation numbers today. Mm-hmm. We've just got persistent volatility that I don't think will dissipate through the course of this year. Rates, as you mentioned, are probably going to stay elevated for a little bit longer. So how can investors effectively weather the storm? How do they look to the ETF market to find what they need to manage that portfolio risk? Is key.
It seems like we're going to be seeing the volatility. The reasons for it might change throughout the year, right? So as you say, then how should investors be thinking about their portfolio and kind of weathering that storm? Like, what are your key tips?
Absolutely. I think what we've seen with the ETF market, and now ETFs in Canada are north of $800 billion. So a very sizable amount of Canadian assets and savings that are actually in ETFs today here in Canada has allowed for a lot of choice, a lot of product available for investors to be able to tailor their portfolios. It's all about customizing to your needs, to your time horizon, your investment horizon, and your risk tolerance. And so the ETF market has a lot on offer for investors. We're seeing an increased usage of active ETFs in Canada by investors. Active ETFs now make up close to 40% of total assets that are held in ETFs here in Canada. And so there's a lot of different active strategies that investors are deploying into their portfolios that are going to take advantage of market conditions as opposed to just riding the storm. And so we've seen an interest in areas like low volatility, as an example. So low volatility equities and stocks where you want to still be invested in the markets, but perhaps you're not okay with how much the markets are gyrating on a daily basis. Mm-hmm. And so you want a bit of a smoother ride. So low volatility equity, for example, has been a place that investors have sought.
You say a higher interest in active ETFs. Is that because people are trying to weather the storm when it comes to this volatility?
Definitely. It gives investors more optionality beyond beta. Beta or index ETFs have long been popular in Canadian portfolios, but active ETFs, active strategies tend to shine actually in market conditions like we see currently. Mm-hmm. And so when you have strategies that are either factor-oriented, quantitatively driven, these are strategies that are trying to benefit from the current market conditions. They're trying to deliver you an outcome, a performance outcome, even in the current environment. And so looking to those kinds of strategies, whether income is a need that you will continue to have and how you generate that income from your portfolio, there's lots of active ways to do that beyond just sort of passive dividend equity, of course. So there's just a lot of choice on offer by Canadian managers now, which is great for all of us as investors and for advisors as they build portfolios for their clients.
Does high inflation make commodities at this time a better investment, do you think?
Definitely. We're spending a lot of time talking about the resource market. We're spending a lot of time talking about Canada's role in resources. We have an ETF on our shelf. The ticker is MORE. It's our core resources ETF. And it's a really good anchor in a portfolio as part of to complement your Canadian equity exposure. Most Canadian equity stock pickers are looking at banks, they're looking at grocers. It is very difficult to get that right when it comes to the resources space, but we're seeing opportunities in resources today that we haven't seen in many decades. And so you're seeing that show up in investors' portfolios in a more meaningful way today. And so we're very bullish, we're very excited about the resource space in Canadian investors' portfolios.
International equities, they've been underperforming North American for years now. What's the case for them now? Are you a little more bullish on international?
Yeah, diversification is going to continue to be a theme where investors are looking abroad. They're looking past the North American borders. We've all been very heavy U.S. equity, Canadian equity for very long in our portfolios. And there's returns to be had outside of North America. There are different drivers of performance and alpha in markets across Europe, for example, so developed markets outside of North America. And there's an opportunity for us from a valuation standpoint to benefit from that in our portfolios here. So that diversification trade, it's been now 18 months that we've seen that persist in Canadian portfolios, which has long been underweight. So it's a great opportunity to look outside and to say, can I get different sets of companies with different drivers of performance in other markets that will benefit from some of this geopolitical difference that we're going to continue to see in the macro environment.
Do you notice a higher interest in certain international markets compared to others?
Yeah, I'd say developed markets, ex-North America, so EFI is a term you will often hear, is a space that a lot of investors are looking to. Emerging markets have been relatively soft from a performance standpoint, even year to date, and so some investors have sort of held steady as opposed to increasing allocations to EM, but definitely developed markets. So you're looking at largely Europe, developed Asia, where you're still seeing good company growth, valuations that are still appropriate from a portfolio management or investing perspective. And so there is some excitement to be had there in terms of allocating to that exposure in your portfolio and actually seeing some stronger returns out of those markets relative to the US and Canada.
Interesting. You mentioned income investing a couple of minutes ago and how it's kind of made a bit of a comeback. Can investors still find meaningful yield in equities, or is that window closing, do you think?
Yeah, it's you've got to go through some other exposures to get a higher yield today. So covered call ETFs are a really big space here in Canada. So there's a number of different high income solutions where there is usage of derivatives to generate that yield for you. Just know that there is a trade-off. It's not a free lunch. If you're looking for yield, it's potentially coming at a cost of something, especially if it's at a higher yield amount. But for some investors, income is the number one driver. They're probably in drawdown, perhaps they're in retirement, and they're looking to just get a general sort of yield distribution out of their portfolio. And for that, higher income solutions like covered call solutions can be quite meaningful in terms of allocation, but there's a performance trade-off to everything, right? So dividend equity, though, today is going to get you 2 to 3% at the most, depending on which geography you're looking at. So it's not as attractive potentially as even the shorter end of the curve on fixed income, which could come with its own risks, but really looking to covered call ETFs and other structured product that can deliver you that income and understanding those trade-offs is probably the best place to go.
Just before we wrap up, we talked about this off the top, but how are advisors rethinking the way they build portfolios today? Like, is the old passive investing playbook still a good strategy?
Yeah, investors and advisors are benefiting from a very large market of solutions today. The democratization of all sorts of exposures is well underway, which means that there's more tools in the toolkit for the average investor and the advisor. And we want to continue to see that grow here in the Canadian industry. I also serve as vice chair of the Canadian ETF Association here in Canada. And we're certainly continuing to lobby, whether it's government regulators, to ensure that we're doing all that we can to drive a vibrant ETF market here, because it benefits all of us as investors. So we'll continue to see advisors look to the market for more choice, more active solutions, more liquid alt solutions. Liquid alternative ETFs are also becoming a broader conversation for advisors and investors, because there are going to be more complex products that we need to seek and look to generate the return and the yield that we might need in our portfolios moving forward.
Interesting. Okay, so much to talk about, so little time. Appreciate you coming in. Thanks so much.
Thank you very much.
That was Prerna Matthews, VP of ETF Product Strategy at Mackenzie Investments. Coming up, we'll bring you the latest headlines and we'll update you on the markets, and we'll also hear why Gulf Oil's Tom Closa sees gasoline climbing above $5 US a gallon on surging oil prices if the Strait of Hormuz is not open. Stay with us. That's next. Shares of Paramount Resources are up today. The oil and gas company lifted its production guidance for 2026 on stronger output at an operation in Alberta and an earlier start for another processing facility. The Calgary-based company says it expects capital expenditures for the year to be lower because of stronger well performance and improved capital efficiencies. And first quarter profits and revenue for George Weston rose compared to a year ago. The Toronto-based company holds large stakes in Loblaw and Choice Property REIT. The increase was largely driven by the completion of the valuation of certain intangible assets tied to the 2014 acquisition of Shoppers Drug Mart. And shares of Pet Value are falling steeply today. First quarter revenue for the retailer met analyst expectations as same-store sales remained flat. The Markham, Ontario-based company also cut its earnings forecast, citing persistent consumer weakness and higher costs in the early part of the year. The specialty retail company says Q1 performance was impacted by a rise in value-seeking customers. And we're watching North American markets today. South of the border, things are not looking so good. The Nasdaq down by more than a full percentage point. S&P 500 also down by 0.7% as investors there weigh the inflation data we saw come out this morning in the U.S., which shows inflation ticked up more than 3%. TSX also down to start the day, down by 0.3%. Tom Kloza, chief energy and advisor at Gulf Oil, says reopening the Strait of Hormuz is the only lever you can pull that has a major impact on fuel prices. And he's warning that gas could reach $5 US a gallon or higher this summer if it stays closed. Earlier, we got perspective on his outlook in a Bloomberg interview, and he began by explaining why pausing the U.S. federal gas tax would only have a limited impact.
Reopening the Strait of Hormuz is the only lever that you can pull that really has a major impact. Yeah, he is right. The president is right when he said that people thought we would go to $200 to $250. He's right. But what he didn't say is that gasoline prices and diesel prices in some parts of the country, wholesale, are already above $200 a barrel. So short of reopening the strait, there's really not anything you can do. And the whole notion of dropping like a rock, the big banks have come out with their analysis, and they admit that they were wrong. Everybody was looking for this to be like a horizon event where it would be over very shortly. And every analysis counts on an imminent return of the Strait of Hormuz, but we're not seeing it.
Morgan Stanley among those banks predicting the bull case, at least $130 to $150 a barrel, calling this a race against time. Tom, how much time do we have before those prices might be realized?
Well, I think the $100 barrel price that we're seeing now is predicated on reopening the strait around June 1st, maybe the first half of June. Okay. The question is, when it reopens, is it going to still be pumping 14.3 million barrels a day of crude and 2.5 million barrels of refined products? I think not. And right now, I mean, it's just as dead calm in the strait, and we're just not getting rerouted oil. And China and the U.S. have helped in terms of utilizing their strategic resources to temper some of the advances we've seen.
Well, and on China and its stockpile, Tom, that obviously is going to be front of mind as the president makes tracks to Beijing to meet with Xi Jinping this week. They have, because of the stockpiles they had, been somewhat more insulated from the closure of the Strait of Hormuz. But how long should we expect their ability to withstand that to last? Because I would imagine that that's going to, at some point, impact how much China wants to get involved in trying to bring an end to this.
Yeah, that's a good question. And whereas in the United States we have transparency where we know we have 500 or 400 million barrels in the SPR, there's various estimates in China. Most people probably think it's 1 billion barrels or so that they accumulated largely last year from buying when the price was cheap. If they were oil traders, they were doing a real good job. But how long will they do that? And they're not only relaxing imports and not importing as much, they've actually been taking some of the barrels owed to them and turn around and sell those cargoes on the market. And that's calmed down some of the furor that was there that sent Asian prices for crude as high as $170 a barrel.
Just curious, in our remaining couple of moments here, Tom, about physical shortages. We had received warnings that they could be starting any time now in the UK, in Asian nations. What do you expect?
I expect the worries will be on the middle of the barrel. Diesel gets worrisome here in the next month. We're exporting, or last week we exported about 1.8 million barrels a day, and we use about 3.5 normally. So we're finding a market for more oil or more diesel than we could make, and those prices are about to go ballistic. The record was in June of 2022, and I think it was about 580. And we'll probably blitz through that, particularly in the Midwest, where they're dependent on diesel, not just for freight, but for farming as well.
So quickly, Tom, even if we are to see a gas tax holiday knock off 10 to 18 cents or something off of a gallon of gas, how high do you think prices could get as we head into the summer driving season?
Well, I think if the strait doesn't reopen, we could see $5 and substantially more if there's a problem. What I'm worried about this summer is hurricane season, because we've been blessed without a hurricane impact in the Gulf of Mexico for the last few years. If you get an impact, a Category 3 or greater, and you lose U.S. refining and you lose the capability of exporting some of the crude, this thing could really go to an apoplectic level.
Coming up next is Hot Picks. We will zero in on 3 plays in the restaurant sector when we come back. Stay with us. It's time now for Hot Picks, and today we are zeroing in on the restaurant sector. Our next guest is highlighting a beverage company's Texas branch, which may be going from problem child to golden child. So let's welcome in John Tower, equity research analyst at Citi. Great to have you join us. Thanks so much.
Hey, thanks for having me, Lindsay.
So I guess we'll get right into your hot picks for today. And this first brand is maybe not as well known as the next two. So let's start off with Dutch Brothers. Tell us more about it and why it's your hot pick.
Yeah, Dutch Brothers is a fast-growing beverage-centric concept, mostly drive-through with a walk-up window. That's been compounding its store growth at a high teens, low 20% clip. That's translating into roughly similar levels of EBITDA growth. They've been penetrating across different markets in the U.S. They started in Oregon and made their way through Texas, and they're still infilling all the way across the East Coast. They've got spots now in the Carolinas and Florida. And the idea here is they're kind of building off of the away-from-home beverage category, starting with kind of cold coffee, but importantly, they've been the leader in energy, customizable energy for the industry. And that's about 26% of their sales mix today. And they've been winning with Gen Z and winning with younger guests, Gen Z, millennials, through ongoing product innovation, great hospitality at the store level, fast throughput and attractive price points. And we see that continuing into the future. The stock has come under quite a bit of pressure, frankly, over the past 12 months, and specifically year to date, as investors have feared McDonald's and other concepts moving into the beverage market, specifically energy, in 2026. I think those fears are overblown. While I think it's a good opportunity for McDonald's to build out that platform in the U.S. and other brands do the same, I think what Dutch Brothers has demonstrated to date is that they've got a capture program in place with their existing customers that constantly brings them back. And frankly, as others highlight the energy market, I think what we're going to see is Dutch Brothers consumers continue to gravitate to that brand, meaning Dutch Brothers, over time, given, frankly, the customization and hospitality that the stores offer. So I think it's great. I think it's undervalued. And as we move through, the summer window, when McDonald's is effectively expected to launch its energy platform, I believe you're going to start seeing Dutch Brothers stock performance really pick up from there as this whole competition thesis gets debunked.
Why were they originally considered maybe a bit of a problem child?
That was the Texas market specifically.
Oh, okay.
Under the old management team, they expanded into markets quickly and didn't necessarily have a thorough strategy on how to attack the market. And what's transpired under new management is a much more thoughtful way of approaching markets. Specifically, they're seeding and supporting a number of these stores with much greater spend around media, social, more than anything else, to try and build brand awareness and frankly, build some customer frequency. And they've got a much better rewards program in place now. So brand familiarity is much higher when they're moving into these markets, and recapture of guests. You try it one time, come back in because it's such a good experience at a reasonable price point.
Got it. Okay, so let's move on to your next topic. It is McDonald's. You say McDonald's obviously contending with the same macro pressures as some of its peers, but why do you like McDonald's?
Their balance sheet is phenomenal. I think they've got a number of drivers in place that will help turn around the story in the U.S. And frankly, when they just reported results last week, they spoke to a weaker April. That was one of the more challenging comparisons from 2025. They had a Minecraft tie-in. It was a difficult lap. Going forward, it's going to be an easier path for their sales over the next several months. We're going into World Cup season. They're the official sponsor of the World Cup from a restaurant perspective. But importantly, I think what they're doing now with respect to marketing and product innovation, it's just a much faster pace of both and frankly, velocity of ideas coming to their menu that will resonate with guests. So right as of last Tuesday, I believe it was, they launched part one of their new beverage platform in the US. It was refreshers. Think of just carbonated drinks with a little bit of syrup or dried fruit to try and start attracting different customers for different occasions. Some attach. Next round of this stuff's going to come probably sometime this summer in the form of energy, and they're attacking it at a value price point. It's going to be interesting to see who they win share from. I think broadly the energy market in general and the beverage market in general is just growing in the food away from home category. And I think that's going to help drive some of their business, drive some attach. They've also got a lot more by way of product innovation. I think you're going to see more by way of chicken coming later this year. And then importantly, they're going to step on the remodel gas sometime sooner rather than later. We're probably going to get teased some of that in the second quarter call. We'll get more information in their fall investor day in September, where they'll likely outline plans for the remodel cycle in the US. And if you look back, the last time they did this, the experience of the future remodels, it really transformed their asset base in the US and led to a lot of capture of traffic within the industry. And it allowed them to jump well above the competition in terms of how their assets were viewed in the eyes of the consumer, which meant stickier sales over time. So I think we're going to hear from them in the fall with more details, but I think they've got a good path here for multi-year top line growth from a same-store sales perspective. On top of it, globally, they're still growing their footprint in that 4 to 5% range. It's right up there with all the other global QSR brands, and I don't think they get enough credit for it.
Lastly, we want to get to your last one, Chipotle. You believe that there's room for positive growth, positive re-rating with Chipotle. Why is that?
Yeah, look, they've been very conservative with their guidance to start 2026. It even started in the fourth quarter with their results, but they, I think, have set a low bar for expectations. I think what you're seeing here is similar to what we've seen across other brands across the industry, which is there's a much greater pace of innovation and new product news to drive consumers back to their stores. You couple that with more attractive marketing. They are starting to weave some price points into conversations when they're speaking to guests, and they've got a revamped loyalty program. I think all of these things are going to lead to accelerating same-store sales growth in the U.S. You still have high single-digit unit growth and, frankly, measures in place to ensure that all of this marketing and all the investment that they're making on new products aren't necessarily coming at the expense of profits. They're weaving in new kitchen equipment across their system, going to make them much more efficient and, frankly, allow for catering across their store base, which might be a whole new layer of sales growth for them. So to me, you're going to see accelerating same-store sales on a stock that's been hammered for the past year. And accelerating same-store sales in this industry generally translates into improved price momentum for the stock.
Okay, we'll have to leave it there. We're out of time. John Tower, equity research analyst at Citi. Appreciate your time. Thank you. Coming up next, we'll have one last check on the markets as North American stocks come under some pressure today, largely due to the CPI numbers coming out of the U.S. this morning. More on that after the break. Two reports are out today that paint a more detailed picture of trips taken by Canadians to the U.S., and we now have a better idea of how business and pleasure travel have changed as a result of Donald Trump's trade war. CTV senior correspondent Mike LeCouture has the numbers for us. Take a look.
Ottawa's Tulip Festival is a huge draw for tourists. These Montrealers used to take an annual trip to the New England coast, but since Canada-U.S. relations started to wilt, they're traveling domestically instead.
Stay in Canada and spend our money here rather than encourage the American people who have this silly leader that they've got.
And it seems they're not alone. Researchers from the University of Toronto analyzed Canadian cell phone usage in the U.S. over a period of 2 years and found a median decline of 42%, more than the initial estimates of a 25% decrease. But that did include freight travel and Canadians who have to travel to the U.S. for work.
We think they're taking a lot more meetings at home in Canada on Zoom.
Researchers say it's even more apparent in some industries hit by the trade war.
You're seeing much less travel to places like Grand Rapids, Michigan. That's not a loss of tourist travel. That's a loss of trade-related travel related to the auto industry.
The new numbers from Statistics Canada show a slight uptick in cross-border traffic last month. In April, 1.8 million Canadians made return trips to the U.S. That's up 1.4% compared to the same month in 2025. It's the first time there's been an overall increase since December of 2024.
There will be those that will not travel to the U.S. no matter what, but I'm seeing many that had that attitude at the beginning are now softening and actually traveling now and going there also.
Despite that bump, Stats Canada numbers show when you compare April of this year to April 2024, before cross-border tensions reignited, travel is still down by 30%. Omar.
Okay, that was CTV's Mike LeCouture. We're going to take a quick check on the markets here before we wrap up today. There's a couple of stocks we're watching in particular. Pet value. Okay, we'll start with the TSX. It is down in intraday trading, down by 0.3% at the moment, continuing to see if we can see some gains there. We're watching some certain stocks on the TSX. Pet value is one of them. Shares are falling sharply today, down, wow, more than 15% at the moment after first quarter revenue for this retailer met analysts' expectations, but same-store sales remained flat. Now, this is a Markham, Ontario-based company. It also cut its earnings forecast, citing persistent consumer weakness and higher costs in the early part of this year. So continuing to watch Pet Value today to see how it fares. On Holdings is another company we've been talking about this morning, and we're watching closely. It is lower after outsized growth fell short of expectations. On Holdings down by more than 6% at the moment. And we're also watching Wendy's. Train Partners, this is news coming out today, is seeking a bid to take Wendy's private. It seems as though investors feeling pretty confident about that. Look at this one-year chart, and today up over the last year, up almost 15% at the moment. So it seems to be getting a bit of a rebound today. Under Armour, another company we're watching closely, it has been struggling. Adjusted EPS missed estimates in the latest quarter, and you can see Under Armour over the last year down almost 19%. We're also keeping an eye on some of the commodities for you today. Of course, oil is one we're watching for pretty closely. Oil is extending its gains today as Trump casts some doubt over a ceasefire with Iran. It seems as though it's going to be prolonging the closure of the Strait of Hormuz. And obviously, oil spiking today up more than 4% at the moment on that news. On the flip side, also watching gold. The price of gold is sliding lower as investors assess that deadlock in the Middle East conflict. It's down more than a full percentage point at the moment. And we're also keeping an eye on the loonie. It was falling earlier this morning. It still is ahead of that U.S. inflation data that came out shows that U.S. inflation ticked up more than 3%. We're seeing that reflected on the Canadian dollar here at home. That wraps up this edition of the Open Morning Markets with Roger Peterson is next.